Hello and welcome to the Credit Compass, your guide to navigating European credit markets. Each week we unpack the key moves in credit, explore the macro trends shaping the landscape, and dive into the strategies that matter most for investors across Europe and the UK. Trade tensions continue to dominate headlines this week, but this time the spotlight is firmly on Europe. With transatlantic negotiations heating up and tariff threats looming, the continent enters a delicate balance of diplomacy, and companies are reacting with supply chain maneuvering. UK GDP forecasts are improving, according to the IMF, as regulatory shifts and consumer sentiment indicators add further texture. This episode unpacks the key developments. Let's get into it. Trade has been the theme of the year, and now it's Europe's turn in the spotlight. The transatlantic trade relationship is once again under scrutiny as tensions escalate over tariffs and the pace of negotiations. The U.S. administration, aiming to recalibrate trade balances, has threatened new punitive measures, including a potential 50% tariff increase on select European imports. These threats emerged amid frustrations in Washington that European negotiators were perceived to be dragging their feet, reflecting a slower, more consensus-driven approach that is typical of EU institutions. This flashpoint was temporarily diffused following a high-level call between European Commission President Ursula von der Leyen and U.S. President Donald Trump, during which both sides agreed to extend the negotiating window. The new tariff threat deadline is set for July 9th, just one day after the broader 90-day global tariff extension expires, an intentional move that subtly raises the stakes. At the core of the talks are disagreements over industrial goods, agricultural standards, digital service taxes, and state subsidies, areas where transatlantic alignment remains elusive. The EU is not standing still, though. Brussels has readied a €21 billion tariff retaliation package, specifically targeting politically sensitive American exports such as motorcycles, bourbon, and textiles. An additional €95 billion in duties are queued up should talks falter further. However, current expectations suggest that negotiations may culminate in a framework similar to the UK-US mini-deal, a non-binding heads of terms agreement with significant technical and sectoral details still left open for future negotiation. One observable consequence of these tariff tremors has been a surge in advanced shipping orders. European ports from Rotterdam to Antwerp are now dealing with mounting backlogs as importers attempt to front-load inventory ahead of possible tariff enforcement. According to data from port authorities, berth waiting times have increased by 15% or much more, and container freight rates, which had been declining up until March, have increased across major lanes, reversing earlier trends. Notably, this preemptive import behavior is not limited to Europe. Ports in Asia and North America are also reporting elevated traffic, reflecting the global nature of supply chain anxiety. Adding to this logistical pressure is a broader trend towards onshoring and inventory buildup. With many trade deals, including those with China, still unresolved or under renegotiation, companies are hedging by shifting from just-in-time to just-in-case strategies. This is particularly visible in the pharmaceuticals, semiconductors, and critical raw materials sectors, where strategic stockpiling has become a boardroom priority. On the regulatory front, the EU is moving cautiously to keep in step with the US, where financial rulemaking has been effectively paused. Most notably, the European Commission has recently postponed the implementation of the Fundamental Review of the Trading Book, a cornerstone of Basel III regulations, from 2026 to January 2027. This delay reflects concerns over the competitive impact on European investment banks, which argue that early adoption could place them at a disadvantage in comparison to U.S. peers still operating under a lighter touch regime. The delay also underscores a desire to preserve regulatory parity in transatlantic capital markets. Beyond traditional banks, the regulatory lens is expanding to encompass the broader shadow banking sector. The European supervisory authorities, led by the European Central Bank and ESMA, are preparing the first pan-European systemic stress test for non-bank financial intermediaries, including hedge funds, private equity firms, insurers, and pension funds. These entities now collectively hold over 4.75 trillion euros in credit exposures, accounting for roughly a quarter of total Eurozone lending. The tests will model shocks such as liquidity mismatches, counterparty failures, and asset fire sales, key risks in a system where leverage and opacity remain high. The approach mirrors recent efforts by the Bank of England, which in early 2025 ran similar stress exercises focused on interconnectedness and non-bank systemic risks. It would be a while before any potential regulation came as a result of these stress tests, but the information will be helpful to assess the impact that private credit may have on the financial system as a whole. Shifting focus to the real economy and consumer sentiment, the mood is tentatively improving across parts of Europe. On Friday, May 23rd, the UK's GfK Consumer Confidence Index rose to -20, up from -23 in April, marking the highest level since late 2021 and beating consensus forecasts. The improvement was driven by increased optimism over personal finances and easing expectations of inflation, even though the latest print suggests otherwise. Similarly, the Eurozone Consumer Confidence Indicator ticked up, supported by notable gains in Belgium and Ireland, where lower energy prices and positive labor markets are stabilizing household sentiment. Conversely, French consumer confidence slipped, reflecting ongoing political unrest and persistent concerns over purchasing power. The IMF has just released its latest forecast for the UK economy, offering a cautiously optimistic outlook. Growth expectations for 2025 have been nudged up to 1.2%, reflecting better than expected performance in the early part of the year and growing confidence in household spending. Looking further ahead, 2026 growth is projected to reach 1.4%, supported by improving property prices, fiscal expansion, and anticipated rate cuts from the Bank of England. However, the IMF highlighted that the risks to growth remain to the downside, with tighter than expected financial conditions and rising precautionary household savings, similar to what we have been seeing in Europe. The IMF now sees UK inflation averaging 3.1% in 2025, higher than previously forecast, citing stubborn price pressures in services and energy, something that we have also been discussing over the past several weeks. Geopolitical and fiscal risks remain on the radar. The IMF warns that ongoing global trade tensions, especially those linked to the US tariff threats, could dent UK output by 0.3% over the next year, a hit of nearly £8.5 billion. On the policy front, the fund welcomed Chancellor Rachel Reeves' plans to reform the UK's fiscal framework. Overall, the UK is holding its ground in a volatile global environment, but vigilance remains the watchword. So, where does that leave us this week? European markets continue to outperform, but the risk of increased tariffs has not disappeared. Looking ahead, the path forward remains clouded by geopolitical risk, supply chain frictions, and divergent monetary policy trajectories. But amid the noise, the underlying themes, strategic decoupling, regulatory recalibration, and fiscal questions, are beginning to shape the European financial narrative, one that blends caution with structural reform, as well as early signs of positive sentiment shift. That's all for this edition of the Credit Compass. If you found this episode helpful, please like, subscribe, and share it with friends and colleagues. If you have a question or a topic you'd like us to cover, please do get in touch. We'd love to hear from you. And for more in-depth financial research and credit ratings, please visit us at kbra.com. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.